So let's go through some exercises together. Please fill in the blanks given the fact pattern below. So here we have an investor balance sheet. So we start before they've made an investment. They have cash of $110 million, other assets of $100 million, and corresponding liabilities and equity. Now this is, again, we're going to continue with the hypothetical of Google acquiring a 25% stake in Yahoo. Just the numbers are a little bit different. So let's say the Yahoo book value is $16 billion, and they're going to take a purchase price of $10 billion. So we've got the same excess in book value that we talked about. And then the investors' working papers, we're also showing that, with the intangible assets that have been that are written up as a result of this have a useful life of 10 years. They represent $4 billion of the $6 billion excess. And then the rest is attributable to goodwill. So hit the pause button and try to identify what's going on the day of the initial investment. Once you're ready, hit on pause and we'll go through it together. Okay, so hopefully everyone was able to get that really there's no difference from how in the prior exercises we've recognized the investments. These two intangible assets and goodwill were just little tricks to try to distract you. But on the actual consolidated balance sheet, the only thing that's recognized on the initial day is the total purchase price as the investment in affiliates, and the corresponding credit is the cash. Right? The fact that on the investors' working papers, they've allocated that $10 billion working purchase price to intangible assets, to the original book value and goodwill, doesn't show up on the investor's balance sheet. It's all aggregated within this line item here. Okay, the next exercise is to actually calculate what the investor GAAP income statement looks like as a result of this investment. So please fill in the blanks given the fact pattern in the prior exercise, namely the initial investment and the balance sheet, and then identify what is the net income, and then fill in all the line items to get you to net income, as well as what's going on in the investor's working papers to get you to this net income. Hit the pause button, give this a shot, and then we're going to go over it together. So we have an investor income statement with revenues of $300, expenses of $200, and operating profit. This is before the affiliate income. The affiliate Yahoo is generating $16 billion in net income. So this is a little bit different from the prior exercises. So just be careful because we provided a different net income in our prior hypothetical. And so we're trying to understand what is the net income of the investor, namely Google here. In order to answer these, we actually have to go to the investor working papers. First, let's understand that Yahoo is reported $16 billion of net income. So before making any adjustments to reflect the fact that we paid way above book value to acquire 25% of Yahoo, we would have just recognized 25% of the $16 billion as just $4 billion. But of course, because we paid so much above book value, we have to make an adjustment for the amortization that we recognized. Recall that we recognized intangibles as being worth about $4 billion more than what they're being represented on Yahoo's own balance sheet. So intangible assets got a write-up on our own internal working papers of $4 billion with a useful life of 3 years. Or I should say of 10 years, excuse me. Useful life of 10 years means that every year intangible amortization is $400 million. So what we are recognizing is not $4 billion, but rather an adjustment down. We have to adjust to reflect this excess amortization. So really what we are going to recognize is income not of $4 billion, but income of $3.6 billion. And notice all of the work is happening on the internal working papers, but what's being represented on the Google income statement is going to be this net figure of 3.6. So operating profit is 103.6. The next question is, what do we do about tax expense? And this is actually very similar to what we have done in prior exercises. There's nothing really going on here that we haven't already covered, which is operating profit before affiliate income at a 40% tax rate is simply going to yield a tax expense of 40. And let's assume these are all cash revenues and cash expenses, means that cash taxes associated with the affiliate, or I should say with the investor itself before the affiliate income, is going to be 40. But in addition to that, and this is what the working papers are for, is to recognize that at a dividend received discount of 80% and a corporate tax rate of 40%, we've recognized affiliate income of 3.6. And so let me actually put this off on the side here. The taxes from the affiliate income equals 3.6. This is the income that we recognize, Google, I should say, recognizes because of this amortization adjustment, times 0.4 for the tax rate, times 0.2, which is 1 minus the dividends received deduction. That equals 0.288. So not a lot of tax. Incremental tax. And of course, this is non-cash tax. We're only going to have to pay cash taxes associated with any affiliate income as if they give us dividends, and we haven't identified any dividends. So this is just becomes a deferred tax liability, as we've talked about before. And from a tax expense GAAP standpoint, it doesn't matter whether it's cash or deferred. It's recognized as a GAAP tax expense. And the net result is this net income. I'm going to go to the next screen where we've done the calculation. And we get to net income of 63.3. So that's how we complete the income statement. And then the next exercise, at this point, we can actually show you how the balance sheet impact, what the balance sheet impact looks like after a year's worth of these operations. So why don't you give this a shot as well? Now that we've identified the investor income statement as well as their working papers, you can now complete the balance sheet that takes you from the day one after the initial investment, where we now have this investment in affiliates of $10 billion. We know that we paid $6 billion in excess of the book value of the Yahoo assets, or the Yahoo equity acquired. After a year's worth of this income statement, what is the final balance sheet going to look like? Hit the pause button, give it a shot, and then we'll go through it together as a group. Okay, so now we can complete this exercise. So equity, as we know, always goes up by the net income. So 63, there's an adjustment up of 63.3. There's going to be a new deferred tax liability created of 0.288. Now, in terms of what's happening to cash, we can go through this just logically. We have cash revenues of 300, expenses of 200. That puts 100 in our pockets, but we also owe the government 40. So the only thing that's happening to cash is an increase of $60 million. That's the operating profit net, the cash tax liability. Investments in affiliates went up. And this is the main point here. Investments in affiliate went up not by $4 billion, but by $3.6 billion. Nothing is happening to intangible assets. Nothing is happening to goodwill. You see, all of those things are happening to the Yahoo intangible assets and Yahoo goodwill, which is all sort of captured within the working papers that lead to these numbers, and that's the main takeaway here. Nothing's happening to other assets. And so we have 63.6 which exactly equals, this is the net change, which is exactly equals the net change here, 63.3 plus 0.3, which is, we're just rounding up. So here on the screen, we see it all completed, and we see exactly what we just described. And now we see what a balance sheet looks like, what the investment in affiliates impact is on a company's balance sheet when you pay in excess of book value, which is what happens most of the time.